Welcome to the deep dive. And wow, the sources you sent over this week, honestly, they looked pretty intimidating at first glance. Just this really dense stack, right? Heavy market analysis, deep tech stuff, global finance. Yeah, felt a bit like homework just opening the file. But that's what we do here. Our mission today is simple. Break it down. We want to go beyond just the headlines, really understand these huge shifts happening underneath. Okay, let's unpack this. We're taking three, frankly, incredibly complex situations full of jargon and turn them into clear, memorable knowledge for you. The goal is really to cut through that financial noise and help you grasp the why behind it all and maybe the so what. What does it actually mean?
Exactly. And you're right, on the surface, these three areas might not seem connected at all.
Not really, no.
You've got this new tech partnership, then U.S. cash flow issues, then European debt. It's like, where's the common thread? But actually, when you look closer, these represent the key pivot points in the global economy right now. They really demand attention because they're fundamentally changing things, how assets get priced, how risk gets measured. It's all shifting.
Okay, so a three-part journey today, then, we're going to cover. First, that surprising, almost odd couple, right? Tech alliance between NVIDIA and Intel, two old rivals. Second, this silent drain of money. What's really going on with the U.S. liquidity crunch everyone's whispering about, and why that old saying cash is king is, well, maybe more relevant than ever. And third, the big change in Europe's bond markets. What's really driving those long-term yields now? Because the story has definitely changed.
Sounds like a plan. Big topics, but crucial ones.
Right. Let's start maybe in the digital trenches with the chip story, because this is pretty wild. When NVIDIA first announced that huge investment in Intel was like $5 billion, it looked like just, a financial move.
Just money changing hands,
Yeah.
exactly. A big check.
But the sources we looked at make it clear it's ballooned way beyond that. It's now a full-on strategic R&D marriage. And it's got a name, Project Prometheus.
That's the absolute key, Prometheus. This isn't just NVIDIA buying some chips from Intel. It's a deep technical partnership officially announced for August 2025. And the goal is huge. Integrate Intel's x86 CPU, which is, dominant tonight, and NVIDIA's GPU onto one single, highly optimized chip package. It's like, as one source put it, they're combining DNA, not just Logo bricks.
And it's all about performance for AI, isn't it? NVIDIA's GPUs, they're the powerhouse, the engine, pure speed. But you need something smooth to actually steer the car and manage all that data flowing in and out, right? That's the CPU's job. So if NVIDIA wants to control that whole AI data center experience, they basically need seamless integration with the CPU market. And in data centers, that market is overwhelmingly Intel's x86 architecture, like over 90%.
Exactly, over 90%. So for NVIDIA, it's purely strategic. But you flip the coin, and for Intel, this is potentially a monumental lifeline. Their Foundry Services Division, IFS, let's be honest, they've struggled for years to prove they can compete with the likes of TSMC at the cutting edge. But now, NVIDIA isn't just investing cash. They're becoming the first and arguably the most important anchor customer. They've placed this massive symbolic order on Intel's next-gen 1.4 nanometer process. That's the Intel 14A node.
I remember some analysts were pretty harsh, calling Intel a zombie company not long ago because of those struggles. Is this deal really enough to fundamentally change that narrative? Or is it just, kicking the can down the road?
I think it's truly foundational. It instantly restores a huge amount of confidence. It tackles that market skepticism head-on about whether Intel could actually deliver on these advanced nodes. This validates IFS in a way no press release ever could.
So it makes them a serious contender again.
Absolutely. Securing the future of AI manufacturing, NVIDIA's AI chips no less, on their 14A node. That makes Intel a genuine turnaround story now.
Okay, so huge for Intel. But what about the ripple effects? What does this mean for the competition? I'm thinking particularly of AMD.
Yeah, for AMD, this has to be seen as a pretty severe blow. AMD's big advantage for a long time was that they could design both the CPU and the GPU, offering that integrated system.
Right. They had both pieces in-house.
Exactly. But now, NVIDIA can offer something similar, arguably even more potent, by partnering with Intel. NVIDIA isn't just selling a graphics card anymore. They're selling an integrated platform, Intel CPU plus NVIDIA GPU, designed to work perfectly together. That creates a really powerful lock-in effect for customers. It deepens NVIDIA's market moat, making it harder for others to compete.
And there's a geopolitical angle too, isn't there?
Oh, absolutely. You can bet the U.S. government is seeing this as a major win, a, quote, masterstroke in industrial policy, as one source called it. Why? Because it creates a powerful, cutting-edge, and crucially, U.S.-based alternative to TSMC in Taiwan.
Mitigating that supply chain risk everyone's worried about.
Precisely. It lessens reliance on Taiwan for the most advanced chips. And as a side effect, it's a huge boost for the entire U.S. semiconductor equipment sector. Think companies like Applied Materials, Lam Research, they benefit big time.
Okay, so that chip alliance, that's built on very real physical hardware. But this next topic, it's almost invisible. It's about the flow of money, global liquidity. And this is where, frankly, the plumbing of the financial system starts to sound a little bit scary.
It is a bit concerning. We seem to be at a really critical inflection point right now. The Fed's been deliberately tightening, pulling cash out of the system. That's been the plan. But the growing fear now is that we're getting close to liquidity exhaustion, meaning those crucial cash buffers in the system are running dangerously low.
Okay, let's stick with that plumbing analogy maybe to keep it clear. Liquidity is like the water pressure in the whole financial system, right? And the Fed's quantitative tightening, or QT, is like them slowly closing the main water valve.
That's a good way to think about it. And when that pressure drops too low, well, that's when things can break. You get funding stress, maybe bank problems like we saw hints of in early 2023, credit freezes.
So what are the warning signs? How do we know the pressure is actually getting low?
Well, there are a couple of big indicators flashing red, or maybe amber turning red. The first is something called the reverse repo facility, the RRP. Think of the RRP as the system's main shock absorber, or maybe a backup reservoir for when there was too much cash sloshing around.
Right, it soaked up excess liquidity, held trillions at its peak.
Exactly. But that backup reservoir, our sources are confirming it's basically empty now. The RRP balance hit effectively zero back in July 2025.
Zero. Wow.
Yeah, gone. So that primary buffer, the first line of defense for absorbing unexpected market shocks, it's just not there anymore.
Okay, that's a big change. If that buffer's gone, where does the pressure go instead?
It goes directly onto the banks, onto their bank reserves. These reserves are like the bank's mandatory emergency savings accounts held at the Fed. Think of it as the main water tower for the system.
And that water level is dropping.
It is. Reserves are continuously decreasing, and the concern is we're accelerating towards what the Fed calls the minimal adequate level. That's the point where banks start getting really nervous about lending cash, even overnight.
Yeah.
It signals high stress.
But hang on, it's not just the Fed closing the valve with QT, is it? Isn't the government, the Treasury, also playing a role here?
Absolutely. That's the third piece, and it's crucial. It's the TGA, the Treasury General Account. This is basically the government's main checking account at the Fed. Now, because the Treasury needs to issue a lot of debt to fund government spending, especially with the current administration's expansionary goals, they keep a large balance in the TGA.
And how does that affect liquidity?
When the Treasury issues debt and collects cash, that money often comes out of commercial bank reserves and flows into the TGA. So the government is essentially running a high-powered vacuum cleaner alongside the Fed closing the valve. It's actively sucking reserves, that crucial water, out of the pipes.
Okay, so valve tightening, backup tank empty, and a vacuum cleaner running. Yikes. Is there one clear signal in the markets right now that shows this shortage is actually biting, that it's causing real pain?
Yes, there is. It's the gap, the spread, between key short-term lending rates, specifically the SOFR EFFR spread. This basically tells you the cost of borrowing cash overnight between financial institutions. And that spread, it's widened and seems stuck around 25 to 30 basis points.
Which is higher than normal.
Significantly higher. That's a classic textbook sign that cash is becoming scarce and expensive in the critical short-term funding markets. The shortage is moving from theory to, well, market reality.
So if the system is running dry like this, what should you, the listener, be thinking about? How do you position yourself? What are the key strategies?
Well, strategy number one is probably obvious, but more important than ever. Cash is king. Or maybe cash is dry powder. Holding cash isn't just being defensive anymore, it's actually becoming an aggressive strategy.
How so?
Because when liquidity gets tight like this, it often forces some people or funds into panicked selling. They need cash, so they sell assets, sometimes indiscriminately pushing prices down. If you have that dry powder, that cash reserve, you're in a position to buy quality assets when they go on sale, essentially. You need that war chest.
Makes sense. What's strategy two?
Strategy two is focus on quality. Liquidity stress, like a drought, always hits the weakest players first. Companies with lots of debt, shaky cash flows, they find it incredibly difficult and expensive to operate or refinance when money gets tight. So you really need to focus your investments on high-quality companies. What does that mean? Strong balance sheets, low debt, predictable revenues, steady cash flow.
Big tech.
Often, yes, big tech fits that bill. Also, traditionally, things like consumer staples, top healthcare companies, businesses that can weather the storm because they don't rely on easy money, they survive the drought.
Okay, cash and quality. And what about the Fed? What's the ultimate signal we should be watching for from them? The sign that maybe things are about to ease up?
The big one, the ultimate green light, would be any hint from the Fed that they're ending quantitative tightening, QT, earlier than planned. Or maybe they relax some of those bank reserve requirements we talked about. Or, and this is crucial, if they actively start using the standing repo facility, SRF, that's a tool where they can inject cash back into the system quickly if needed.
So the SRF is like them opening an emergency tap.
Exactly. If the Fed starts actively using the SRF, it means they see the stress and they're stepping in to provide liquidity. That would be a major signal to the markets, likely a strong buy signal for riskier assets.
Okay, so the U.S. is dealing with this cash drought. But if we look across the pond to Europe, it seems they have a different kind of plumbing problem, right? Especially in their bond markets. For the longest time, the narrative was simple. European bond yields were rising because the European Central Bank, the ECB, was hiking interest rates. But you're saying that story has fundamentally changed now.
It really has, yes. The main reason long-term bond yields in Europe are rising now isn't primarily about ECB rate hikes anymore. It's shifted towards concerns about fiscal health, the country's own finances, the old reasons, like fear about high ECB rates causing regulatory pain for bondholders. They're fading. The ECB rate cycle looks basically frozen, maybe even peaked around 2.0%. And get this, regulators are actually starting to talk about loosening rules like Solvency II to encourage big investors like insurance companies to buy more long-term bonds, not less.
So the central bank pressure is off, regulators might even help. Why are yields still climbing then? What's the new pressure point?
The new pressure point, the dominant driver now, is fiscal deterioration. And the spotlight is really on countries like France right now. The market looks at France's numbers. A budget deficit running around 5.6% of GDP, national debt heading towards 120% of GDP. Those clearly violate the EU's own rules.
Right.
And then you add in the political instability we've seen there, and it just ramps up the market's worry. Can the government actually get spending under control? Will they stick to fiscal discipline?
And this is all happening just as the biggest buyer of these bonds for the last decade has walked away.
Precisely. The ECB isn't doing quantitative easing QE anymore. They're doing quantitative tightening QT. They're shrinking their balance sheet. So the single largest source of demand for European government bonds is gone. It's not buying anymore. It might even be selling eventually. This forces countries to stand on their own 2 feet and face the market directly without that massive ECB safety net underneath them.
It reminds me of that loaned money analogy you used. It's like before, during QE, the central bank was basically acting as the guarantor for everyone's loans, right? Masking the real risks.
A very good analogy. The ECB backstop made investors less worried about individual country risk.
But now that guarantor has stepped away, so the lenders, the bond investors, they're forced to look much harder at each individual country's creditworthiness again. Are they likely to pay the loan back?
Exactly. And that forces investors into a process. The source is called filtering gems from stones, or maybe just sifting for quality, trying to separate the good credits from the weaker ones.
So no more treating European bonds as just one big asset class.
Absolutely not. You have to differentiate now. The credit spread, that's the difference in yield between, say, super safe German bonds and bonds from fiscally weaker countries like France or Italy. That spread is widening dramatically. It tells you investors are demanding much higher compensation for taking on the risk of lending to those weaker countries. So individual country analysis. It's not optional anymore if you're investing in European debt. It's mandatory.
And there's another factor pushing yields up too. Something called the term premium.
Yes, the term premium. This is basically the extra compensation investors demand just for the risk of tying up their money for a long time, say 10 or 30 years, compared to just rolling over short-term debt. Because there's so much uncertainty now about future inflation, about future fiscal policy in these countries, investors want a bigger reward for locking their money away for the long haul. So the risk of holding long-duration bonds is just significantly higher today than it was during the QE era.
Wow. This really puts the ECB in a terrible bind, doesn't it?
It's the classic central bank nightmare scenario. They're supposed to fight inflation, which means keeping policy relatively tight, or at least not loosening too quickly. But keeping things tight could push already indebted countries like France or Italy towards a potential debt crisis, which the ECB desperately wants to avoid.
Damned if they do, damned if they don't.
Pretty much. Do they prioritize inflation control or financial stability for weaker members? That uncertainty about which way they'll eventually lean just adds another layer of volatility for the euro and for all European assets.
Okay, so let's try to synthesize this a bit. We've covered a lot of ground.
We have. But I think the key takeaway is that we're seeing these fundamental shifts happening all at once across different parts of the global system. In tech, strategies moved. It's now about building these huge, integrated, defensible ecosystems like the NVIDIA-Intel alliance aims to be. On the macro front, liquidity management is paramount. It really argues for holding cash, focusing on quality investments, being defensive but ready. And in global finance, particularly Europe, it's back to basics. Old school credit risk analysis is king again. You have to do your homework on individual countries.
And for me, the big lesson from the tech piece is just how much the semiconductor landscape has truly changed. It feels like it's changed almost overnight. The game isn't just company versus company anymore trying to build the next slightly faster chip. It's these massive interlocking ecosystems forming, battling for long-term dominance across the entire computing stack.
That's exactly right. And that leads to, I think, the really provocative thought to leave listeners with. Now that NVIDIA has effectively partnered with Intel, cementing its access to that foundational by 86 world, the new strategic battlefield seems pretty clearly defined. It's shaping up as a three-way race. You've got the NVIDIA-Intel alliance on one side, you've got AMD's trying to compete with its own integrated solutions, and you've got the foundry giant, TSMC's, powering many players, but facing geopolitical pressures, figuring out who comes out on top in that specific three-way contest. That could well define investment success in tech for the next decade.